Now that we're halfway through the year, it's a great time to reflect on the year so far and what's ahead. And in this week's Property Insider video, Dr. Andrew Wilson and I dig into what's happened to property, and his latest figures show that every capital city other than one has had double-digit growth so far this year. We also look at what's happened to the economy, population growth, and what's ahead. If you want to keep up to date with the latest property trends, please subscribe to our YouTube channel and click the little bell icon so we keep you updated every time a new show comes out. Well, we're halfway through 2021, and now's a good time to reflect back on the year so far and look forward to what's ahead. And what an extraordinary year it's been. Property values across our capital cities have already experienced double-digit capital growth. And despite the COVID concerns we're experiencing, there's plenty more growth to come. Clearly, buyers are out in force, owner-occupiers, first-home buyers and investors. And they're out there at a time when the availability of supply is struggling to keep up. And of course, this is pushing property values up even higher. The surge in property values has caused the property bears to go back into their caves and to hibernate. And our major banks have done an about-face. They're now forecasting 20 to 30% rise in property values this cycle, with strong growth to continue for some time. And the economic Armageddon that some predicted, that didn't eventuate, and we didn't fall off the sort of cliffs that were meant to litter our path, did we? So I'm looking forward to this week's Property Insider chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market, as we look over the year just gone and look forward to what's ahead. Hi, Andrew.
Yes, hello, Michael, and we're in the middle of the year, can you believe it? Almost into July, so the financial year is past and we're into a new financial year, but it's a little bit of deja vu, isn't it, in terms of challenges ahead?
It is very much so. Now, you've given us some great data to talk about. I'm looking forward to seeing what's happened. I also want to get your ideas of what's ahead. But as always, let's start with the recent auction results, last week's results, because that's giving us a good feel of what's happening on the ground at the moment.
Yes, Michael, and I guess we can validate that when we look at the results in terms of house price growth, particularly for the financial year and the first 6 months of this year and the June quarter. We've got some preliminary data which won't be too far off the mark when we get the final numbers through. But we know that auction markets have been very strong this year. And as I said, it's now being reflected, as we would expect, in the prices growth that's being generated. The factors that we've been waiting to see was really a significant fall in clearance rates, with the record numbers of auctions that have been flooding auction markets over May, April as well, and into June. And we had another very big weekend of auction numbers last weekend, Michael, to end June. In fact, June has been a record month for auction numbers in Sydney and Melbourne, quite clearly a record June. But it hasn't had a material effect on clearance rates. In fact, both Melbourne and Sydney, Michael, recorded their highest clearance rates for 8 weeks, for 8 weekends on the weekend, despite, again, nearly 1,000 listings in Sydney, which is quite remarkable, and another big offering of properties in the Melbourne market. Now, Melbourne's quite interesting, Michael, just under 80% clearance rate. But when we look at the chart of the last month or two in Melbourne, you can see quite clearly the impact that the shutdown had on the Melbourne market. Clearance rates fell below 70% at one stage. But as we have seen, that the minute those lockdown restrictions are eased, buyers and sellers come back into the market and clearance rates rise. And we saw that again, as I said, the highest rate in Melbourne since May the 8th, and just under that 80% boom time benchmark. So the Melbourne market certainly picked up after the shutdown, and the other markets are continuing to perform strongly as well, Michael. So the interesting thing is that we've come to the end of the month and there's really no sign that market are easing as we would expect. School holidays, of course, are starting now in most states, and that always does have an impact on the market. July is a pause period for housing markets, but as yet, we're certainly not seeing that occur. But we do have the joker in the pack, unfortunately, Michael, and that is the lockdowns that are now in force at various levels. And of course, that will have an impact, as we know, on housing market activity. But the impact isn't sort of a fundamental hit on the dynamics of the housing market. It's just an impediment to transactions occurring because people, of course, aren't allowed to mix face-to-face. So that pulls out the auction market out for inspections, these type of activities. But we have seen the industry, buyers and sellers have adapted quite well to these environments. And I expect that the property market outcomes as a result of current lockdowns won't be as severe as we saw a year ago. I guess it is a bit of deja vu all over again, but I don't think the results will be quite as severe. And that's what the Melbourne market has shown us over the last month, that once those lockdown issues are resolved, that buyers and sellers, those that have put off their activity, come back into the market very quickly. And there's still a lot of underlying force in our housing markets generally.
It didn't seem to affect Saturday's auction results in Sydney, the sudden lockdown just a day before.
No, without the clearance rate actually increased. And as I said, it was the highest that we'd had since May the 8th. And I think that obviously there's a lagged effect because those auctions were booked in 4 to 6 weekends before, or weeks before. So they were reflecting a bit of backward looking energy. It will change as the weeks progress if we remain in lockdown. But as Melbourne is instructive, that we know that once the lockdown restrictions are eased, that the market bounces back quite quickly. In fact, quicker than it has. Look, it bounced back last year, Michael, when we had shutdowns. And the point to all that is what you said initially, and that's fundamentals have remained strong in both the economy and our housing markets. And really, COVID is more a distraction than anything else.
Sure. Well, let's have a look at the economy and our housing markets and how they've performed over the last 12 months. Let's start with the property markets, because despite the doomsayers' dire predictions that our housing markets were going to crash, they remained resilient last year. Sure, the growth was stifled a bit by a lack of consumer confidence, but we called it in October last year that the markets turned in, and they've gone gangbusters in the first half of 2021. Already, with your figures here, most of the markets other than Perth have already exhibited double-digit capital growth this year alone.
Yes.
So those who heeded the negative Nellies last year, they lost out, while home buyers and property investors who took a long-term view, they're already experiencing quite significant capital growth, Andrew.
Yes, it is a remarkable market, Michael, not just the fact that we're recording around double-figure growth this year so far in every capital city market, with the exception of Perth, which is just a little lower, but these figures are preliminary. They won't be too far off the mark, but what a start to the year. And we really haven't seen these sort of numbers ever, certainly in the modern era. Unique nature of this data is that it's so consistent across each of the capital cities. It's not just a sort of a Sydney boom or a Brisbane boom, which we've seen in the past. It's an across-the-board breakout in house prices. A lot of it is that catch-up energy, with buyers still having a reasonable affordability profile in terms of the fact that even though Sydney's prices have grown by a significant amount over the last 12 months, they're still just around 17% higher than where they were 4 years ago. So that really tells us that the average, even with these extraordinary numbers, particularly coming out of Sydney, is still around about 4% per year over the past 4 years. And of course, we've had more than a 1% fall in mortgage rates and more than a 6% increase in incomes over that period. So this is why we're seeing all this catch-up energy. It's about making up for all the lost opportunities over the last 4 years with all those roadblocks that we've had over that time. Credit squeeze, the fear campaign, the Royal Commission into the banking sector, the last election, all those things. And of course, COVID acted to stifle normal demand and supply matching. And now it's sort of catching up. And there's still some way to go, Michael. There's certainly no sign of trending downwards. And without the dampening effect of higher interest rates, because that story's lost a lot of the energy of a week ago. Of course, I think that those banks, Westpac and Commonwealth, who were predicting higher interest rates next year, in the case of the Commonwealth Bank's economist, would be wanting to revisit those predictions quite soon. We had the intergenerational report out this week, Michael, but it's quite gloomy in terms of the outlook. Sure that now with more concerns over COVID impeding the economy, that the prospect of higher interest rates coming sooner rather than later is just cloud cuckoo land stuff.
Well, looking at house prices, Sydney's been the outstanding performer. Your figures show 17.8% growth this year so far. Melbourne, 11.8%.
Yeah.
Brisbane, 10.7% this year, 2021. Adelaide, 10.4%. And Perth, which has come off a very low base at 8.1%. And the full year, they've all done really well. So they're already going to have double-digit growth this year. The rental markets have been different, though, haven't they? They have suffered a little bit more.
Well, rental is certainly a two-speed rental markets when we look at the capital city comparisons, Michael. There's no doubt that the Melbourne and Sydney markets, particularly in terms of units, rents are still falling. and vacancies are still high. Although let's look at the latest data. The monthly data is actually showing quite a significant fall in vacancies for apartments, inner city apartments in both Melbourne and Sydney, Michael. So they're certainly soaking up that. And I think open borders are affecting that. Fewer Airbnb properties in the permanent market because they are starting to get holiday tenancies and business tenancies. Now, of course, COVID's going to change all that again, but we have seen a starting of an adjustment downwards with those very high vacancy rates for units in Melbourne and Sydney, which, as I said, are particularly inner city and CBD unit vacancies and vacancy rates are falling still high. The other capitals, except for Melbourne and Sydney, Michael, certainly running out of tenanted properties or properties available for tenants. We're seeing vacancy rates continuing to fall for both houses and units in the other capitals, and rents are rising quite sharply. I think we've got two factors working at that. It's we're certainly seeing fewer new supply coming into the market now. But the other factor, of course, in terms of particularly the Brisbane market, is migration patterns. There's no doubt in the latest ABS data reinforced that there's a surge in, and will likely continue in migrants moving into southeast Queensland, particularly from Victoria, and that's putting upward pressure on vacant rental properties and rents, of course. But I think the other interesting thing in terms of the rental data, Michael, is that we're seeing some weakness in rents for houses in Melbourne and Sydney, particularly Melbourne. And I think in some areas that does reflect the migration patterns. And I also think the lockdown issue means there's not as much churn or turnover in new rental activity, new tenants, because of lockdown restrictions. But certainly all the capital city markets, with the exception of Melbourne and Sydney, are clearly exhibiting signs of shortage of rental properties and very strong growth in rents and vacancy rates falling, starting to get down towards zero in a number of those markets.
Sure. Well, over the last year, property values were resilient. Interestingly, our rental markets also, they did remain resilient because each state government introduced their own temporary measures to stabilise the rental markets, to prevent addictions, to support tenants in hardship. And there were all those concerns again, what will happen when those measures were removed, and that didn't happen. Much the same with the economy. If we look back over the last 12 months, the economic Armageddon that was predicted, it proved nothing more than a hysterical paranoia. Today, our economy is arguably the best it's been, well, probably since the GFC. And all those cliffs that were predicted, Andrew, remember that they didn't eventuate. Deferred home loans that would never be repaid and cause mortgage stress. Well, that didn't cause forced sales. There weren't a huge number of mortgagee sales. And unemployment didn't rise to the heights some predicted. And again, there was no cliff after JobKeeper ended. So our economy over the last year experienced that V-shaped recovery that I think we all hoped for, but not many of us expected.
I'm not sure there's actually a letter to describe the recovery's path, Michael. It's beyond a V because the top part of the character is way above the bottom part of the character. So it's not a V, it's like a tick.
It's a Nike swoosh, isn't it?
Yeah, that's right. It's like that, or a tick. Yeah, so it's the tick recovery. Perhaps we can put that one in.
Yeah.
But certainly beyond a V. And there were others talking about the W, which was up, down, up, down. Commentators get seduced by the glory of the cheap headline, and they sort of run away with that. And that's what's happened. We all were in a period of uncertainty. Let's be clear, we future holds in terms of the pandemic outcomes. But logic told you that there was nothing really fundamentally impacting our economy and our housing markets other than confidence and the restrictions of movement. Now, once we could get the restrictions of movement behind us, which we did, and nobody was to sort of predict how that would occur, but we did, we knew almost certainly that we would get back to what we were in terms of our fundamentals for housing market and our economy. And I think the Australian economy deserves a big pat on the back because it really did adapt quite quickly to the changed environment. And, you know, the fact that there was all this predictions at the end of JobKeeper would mean a surge in unemployment sort of meant that people were, it's the old sort of position that people were happy to take a government subsidised income. Well, Australians don't want to be on welfare. They want to get back up and running again, and they did quite quickly. And of course, there was, in fact, rather than a spike upwards in the unemployment rate following the end of JobKeeper, we actually had a spike downwards, Michael. So that was a reverse tick in terms of the end of JobKeeper. But we've still got challenges ahead, but we are a strong performer internationally in terms of our economic performance, and that will continue, but we need to keep adapting to change. And the biggest, obvious impediment is these constant shutdowns, but at least we won't be bombarded and our confidence won't be bruised by relentless predictions of Armageddon for both our housing market and our economy.
Yes, the bears are gone back in their cave. Now, when we look back over the last 12 months, population growth stalled, didn't it? It increased by 136,300 people in 2020, and that was the slowest population growth since ABS records began. Interestingly, we had fewer babies born, and that was the prediction of the demographers too. We're not going to have COVID babies if we're a bit concerned about our financial futures. We hunker down, we don't make more babies. But the other interesting thing is deaths dropped as well. So our population didn't grow much, but I think it's the internal migration that has affected our housing markets, Andrew.
Oh, absolutely, Michael. We've seen some remarkable shifts, and to continue, because all this, the lockdown issues really do, as they keep almost relentlessly impacting Melbourne and Sydney particularly, it starts to have people thinking of options, and the usual destination for that sort of get away from it all is southeast Queensland. And even though it's had its challenges in terms of lockdowns, there's no doubt that southern state lockdowns have accelerated demand to live in southeast Queensland. And there's so many positives for that market in terms of continued price and rent growth, not the least being that it's still remarkably affordable compared to Sydney and Melbourne. So those that do move up there sort of come up with a bundle of cash generally if they have sold their properties in Melbourne and Sydney. And those buyers that are advantaged by high affordability because they can purchase property similar to where they've lived quite comfortably, either on the Gold Coast or Brisbane. And we're seeing that now with very strong prices growth in Brisbane and the Gold Coast, and also rental increases, Michael, for those who go up there in the short term. And the more lockdowns we have, the more we'll have that impetus from southern states particularly to move into Queensland particularly. The other interesting thing in terms of the migration shifts was we had international migration just fell through the floor into Melbourne and Sydney, Michael, net migration. This was predicted down by 90% in both Victoria and New South Wales. But it was interesting that actually New South Wales stood up compared to the rest in terms of net international migration. And I think the better performance from New South Wales was because Sydney's a key destination for expats. And that's helped to keep parts of the Sydney market bubbling along, particular parts, because of high demand from expats who have continued, as if they could, once they can get in, purchase property, obviously, with the same sort of affordability advantages coming from a higher price, perhaps international markets, European and US markets.
Well, one of the things we didn't mention when we talked about the property markets and how they're performing, clearly different segments of the market have performed differently, and one has to look more granularly rather than just say what's happened per state, and maybe we can do that in another chat. But the higher end of the market has outperformed the lower end over the last little while, hasn't it?
And I think that's a bit of that catch-up energy as well, Michael. It was an underperformer, and perhaps trade-in markets been quite strong there as well. All parts of the market have performed strongly, some better than others, but prestige property has been a positive. And again, I think that's because it was flat for a few years, as most of the market was. So there is that capacity to catch up. But really the question now, Michael, is when are we going to start seeing an easing in this? This is not sustainable at these levels. Let's be quite clear about that. We don't have the prospect of higher interest rates to tap this market down. So it will just run out of steam because we can't keep going to the bank and asking for an extra $100,000, $200,000 to pay for the properties that are pay the price that's being asked. So eventually, and of course, the buyer surge will be satisfied to some degree as well. People would have bought, sold, and getting back and enjoying their properties for the next 6 to 10 years, whatever the average is. Well, it is 6 years. But so we're satisfying a lot of demand, and we're not getting the new demand from internationals coming in to offset that. So eventually the market will run out of steam. But the question is, when will it run out of steam, Michael? I still firmly believe that at the end of this year, the Christmas break period will be the time that we really start to see a levelling off and a cooling of our markets. But they'll still have a nice warmth about them, I think, going forward, particularly given my concerns over undersupply of our markets, which I think is a big issue, which we'll have to confront over coming years once we get our health issues behind us.
So to make it clear, we're not talking about property values dropping. The growth is going to slow. And in fact, it's very likely going to slow in the second half of this year
Yes.
anyway. It'll be very hard to keep up the growth it's had recently. But interestingly, despite COVID, well, was it really a recession we had last year? I know you're doubting whether that was the case. Australian households keep getting richer. Household wealth grew more in the last year than it did in the preceding 3 years combined. So despite living through that little recession, household wealth in March this year, the latest figures from the ABS, increased by 15.3%, the fastest rate of rise since the middle of the mining construction boom in 2010. Now, of course, much of our wealth is related to the fact that we own property, which has gone up. But Credit Suisse, which once a year does the World Wealth Report, says Aussies are the wealthiest adults in the world, and now 1 in 10 Australians are technically millionaires, partly because of the value in their homes, Andrew.
Yes, Michael, I saw another report that said on an individual basis, Australia is the second wealthiest country in the world, second only to little Switzerland. That's pretty good considering they're such a small country and they have such a strictly managed economy. But yes, second only to Switzerland and not too far behind in terms of our wealth. So
There's also a World Happiness Report, Andrew, that I saw this morning, and we're amongst the happiest countries in the world as well.
why wouldn't you be when it's only little Switzerland that's doing better than you? So come on, everybody, let's put on our happy face and realise that. And I think it's also interesting, Michael, that the headlines over the last few days seem to be, I'm not saying generally, but just a few of the usual sort of left of centre suspects, and I mentioned CNN as one of them, trying to have a go at Australia for dropping the ball, and Australia thought it was so good, and being highly critical of the fact that we have a handful of COVID cases again, and that's ruined our record now, and we're back to being where Europe and the US are. I mean, come on.
No.
You know, give us a break. We are not even within light years of, unfortunately, what other countries, particularly European and US, have had to suffer through this pandemic. And you'd be pretty confident, and fingers crossed as well, that we'll also manage to get out of what's occurring sooner rather than later. So more cheap headlines, who can be surprised? And from the usual suspects, who can be surprised?
Well, looking back over the last year, our economy's grown, our population has remained stable, our housing values have gone up, we've got jobs, we're feeling secure. So the future's looking bright, Andrew.
Yes, it is, Michael, but what's so different about that?
No, and we should be appreciative of it. Look forward to our chat again next week, Andrew.
Thanks, Michael. Thank you.